And today we're going over Broadcom Semiconductor, or it used to be a semiconductor company, and it has more than quadrupled the S&P over the past 5 years. And yeah, VMware, that's a company that was bought by Broadcom. And let's look at what Broadcom does. Well, it's a technology conglomerate formerly known as Avago, and that's how it got the symbol up here. Avago, we kept the symbol, which originated as a semiconductor company. And now it designs, develops, and supplies a range of analog, mixed signal, and digital semiconductor devices. And it's acquired numerous software companies, which is now 38% of revenues, and includes CA, Symantec, and VMware. That's the one we're talking about just recently, as well as a storage company, and that's of course storing digital data, and that's LSI, and the networking company Brocade, and it employs about 20,000 people. So it's a pretty big company, folks, and now you know how it's growing. It is acquiring other companies, and that's why we like Broadcom. It's not bad. So let's look and see what it does. And Broadcom is in green, and we are comparing against the blue lines, which is the average stock in the S&P 500, and pretty much the average stock in our 1800 stock database. So when we look at the clean surplus return on equity, now that's different than traditional accounting return on equity. We are looking at 54% over the past 5 years versus 13.5% for the average stock. So right away we can see it's better than average stock. Net income. Now, net income represents the clean surplus earnings. So traditional accounting earnings minus non-recurring items and future liabilities like those options they give to their management people. Yeah, you got to take that into consideration as a cost, folks. Anyway, net income 56.8% versus the average stock of 13%. And we like to look at these numbers up here because we want to see that the clean surplus ROE is around the net income. And if it is, that's a pretty good sign. Revenue, 14.5% versus the average company is 7.1%. So it's doubling the revenue of the average company out there, which means it's an above average stock. And that's what we want to put in our portfolios, folks, is the better than average stocks. Now, let us look at some numbers here. Now, net income, again, as I mentioned, the clean surplus earnings, and we can see that it was just going up almost every year, doubled right between 20 and 21. Remember, this was COVID down in here. And then it has been climbing ever since. For 2024, it has declined its net income, and we go over here, by about 32%. But for 2025, now remember, this is not in our computer program yet, so we have far out numbers. So for the 2025, they expect the earnings, or the clean surplus earnings, to double from 2024. So this is what some people are looking at, and they're saying, they didn't have their earnings grow. But folks, look over here at the clean surplus return on equity. To get into our growth portfolio, we want to see a clean surplus return on equity of about 20% or above. Average stock, 13%. So we put a moat in there, as Buffett likes to call it, and we want to see a 20% ROE. Well, this stock is way above that. And we come over here, and I want to show you that when we look at the 10-year average, the 5-year average, and the 3-year average, we would like to see a rise in that ROE. What does that ROE mean? If it is rising, that means the earnings are accelerating each year, not only going up, but accelerating each year. The thing that bothers us is the retention rate is only about 42% for next year, averaging 27%. We like to see a retention rate of 100% in a company that's growing. Now, the retention rate, how much money is it putting back into itself to grow, is distorted by the fact that it is going out and buying other companies. But still, we like to see this retention rate higher. So that's the only shortcoming here. When we look at the revenue growth, again, we show the net income growth and revenue growth way above the average stock out there. So the only thing that bothers us on this chart is the retention rate. We would like to see more money being used for it to grow, more money used to buy other companies or whatever. But folks, this company is definitely making money. When we have years to pay debt, we say, okay, does it have a lot of debt? Years to pay debt is Buffett's rule of thumb is that if a company takes all the money it's making and uses it to pay off debt, how many years would it take to do it? He likes 5 years or less. We like 3 years or less, so that's years to pay debt. 2.2 is well within our range. We like that. Recent dividend is really only 1.6% of the money it's making. And it would look like it would be more, but folks, we really don't want a high dividend. We want to see more money putting it back into itself in order to grow or buy other companies. That's why the retention rate is skewed a little bit here. So let's see how it's done over 1 year. Black line is the S&P 500, up about 28% over 1 year, which is pretty phenomenal. But don't forget, we're coming off of 2022, which was a bad year for the market. So we're rebounding off of that. But this company is up 120%. Folks, that's 4 times higher than the S&P 500. So we can see right in here, it seems to have leveled off a little bit. And in fact, one of the companies out there has a sell signal on this company. Why? Because it has come so far so fast. So there's 2 types of sells. One is when you think a company is going to underperform the average stock, and 2, when you think it has come so far so fast that it doesn't have enough room to grow or not making enough to grow because the growth has already been anticipated. It does not mean it's not a good company any longer. So those 2 differences are something you have to think about. Is it not, are they giving a sell signal because it's not a good company anymore, or are they giving a sell signal, which in this case, because it has come so far so fast that it might level out for a while? But don't forget, if for 2025, they expect 2024's profit to double. So it might have a long way to go, folks. And when we look at 5 years, well, yeah, it's up 350% while the market is up 80%. So even though way back in here it was an average company, and let's look back at that. Back in here, it was an average company with 11.9% return on equity, and then it started shooting up. And let's go back. So we're in 2024. We go back 1, 2, 3 years, and that's when it began to be noticed. And if we go back 1, 2, 3 years, that's when they began to notice. That's when they began to project that, hey, all of a sudden this company is starting to grow. Then we had 2022 when everything fell, and now all of a sudden it is really taken off again. So we're looking at this as it is just making up for 2022, and that it really did start making money back here in 2021. Now, let's look at another company and add it to, I keep saying Avago because that's what it used to be called, but Broadcom, which is this line right in here. Again, black line S&P 500. Here is Broadcom here. What is this stock? Yeah, NVIDIA. And both of these stocks are in our growth portfolio, folks. And both of these stocks are in some of our ETF portfolios, semiconductor and the tech. So these are pretty good companies. And what I want to bring out here is that some people are saying that Broadcom has gotten ahead of itself. What? Look at NVIDIA. Not too many people are saying sell NVIDIA, are they? So, yeah, maybe Broadcom has further to go as it makes money. But you can see in here, it has seemed to be leveled off where NVIDIA was still growing, but NVIDIA has really leveled off also. They've come a long way, folks. I mean, look at these returns versus the average stock in the S&P 500. We're glad we have them in our portfolios. So, folks, look at this beautiful sunrise over the Atlantic Ocean, and maybe these companies, such as NVIDIA, such as Broadcom, are just beginning their day. Well, they have a couple of years ago, but now let's see if they continue to brighten up the sky as they have for the past couple of years in our portfolios. All right, folks, you go out there, you stay safe, and we'll see you back here next week.